Okay, this particular problem will give a chance for us to have some practice with recording write-offs and recoveries. It says, prior to recording the following, Elite Electronics had a credit balance of $1,100 in its allowance for doubtful accounts, and they want us to make journal entries for transactions A and B. Transaction A states, on August 31st, a customer balance for $210 from a prior year was determined to be uncollectible and was written off. That means you tried and tried and you could not collect from this customer and decided we're not going to be able to collect. Let's just write off that account and take it off of our books. So this would be the second part of the allowance method. The first part of the allowance method is to do an adjusting entry to record bad debt expense based on an estimate, and we had to credit the contra account called the allowance for doubtful accounts because we didn't know who wasn't going to pay us and we weren't sure how much. But now, once you've identified a specific customer's balance as uncollectible, you debit that allowance account and you credit the customer's individual accounts receivable account, and that's what we're going to be doing now. We're going to debit the allowance for doubtful accounts. I apologize. For $210. And we're going to credit that customer's accounts receivable account. Now let's just make a T account for them to show you what's happening. Let's give this customer a name. Let's say it's Smith. In our subsidiary ledger, where we keep track of who exactly owes us and how much, that customer would have had $210 in there that they owed us from a prior purchase. When we decide their account is uncollectible on August 31st, we credit to remove their account from our books. They still owe us the money, but we've decided we can't collect, so we just remove it from our books and they now have a zero balance. But on December 15th, the customer comes back in. The $200 that was previously written off on August 31st, they now pay us in full. The problem is that when a customer pays you, we usually debit cash and credit their accounts receivable. But right now, that customer has a zero balance. So we can't credit their accounts receivable yet. We first have to reverse the write-off. So your first step when you have a recovery is to reverse the write-off entry. We're going to debit accounts receivable to restore their account on our books, and we'll credit the allowance for doubtful accounts. That will put their account back on our books. And then you can debit cash and credit that customer's accounts receivable account. And again, they have a zero balance. Now you may wonder, why are we doing this in two steps? Why are we putting accounts receivable back just to reduce it again? And the reason is we want a history for that customer. Because when you write off their account back here, you will probably call Equifax or Experian or TRW, and you'll report that this customer did not pay you and you had to write off their account. That customer's credit rating will suffer. So eventually if they get the money together, they may want to come in and pay you and help restore their credit rating. So we want to show that the customer came back and then paid you, and of course you would call TRW or Experian or what have you, and let them know that the customer came in and paid you. You want a full history, because what if that customer comes in again and wants to purchase from you on account? You need that full credit history to help you make that determination as to whether you'll let them purchase from you on account again. And that's the end.